When I talk about trading without fear, I'm not talking about being reckless or blind to risk. I'm talking about the kind of calm that comes from knowing what the tape is telling you and having the nerve to listen. Fear comes when a man is guessing. Confidence comes when he is observing. And the market, if you watch it long enough, will always tell you what it intends to do. Most traders don't lose money because they're stupid. They lose money because they argue with the market. Have you ever noticed how hard it is to sit still when prices are moving against you, even when nothing has changed on the chart? Back when I was a boy watching stock prices chalked on a board, I learned something that never left me. The market moves in trends, not in straight lines. A stock that is going higher will look weak many times on its way up, and a stock that is going lower will look strong more often than it should. If you let those small moves scare you, you'll never ride the big move. Fear makes a man grab small profits and take big losses, and that's a crooked way to do business. Why should you sell just because the price wiggles a little when the trend is still pointing in your favor? The tape doesn't lie, but it does test you. It tests your patience. It tests your discipline. And most of all, it tests your courage to sit with a good position. When I'm in a trade that's acting right, I don't feel brave. I feel quiet. That's how you know you're trading without fear. You're not hoping. You're not praying. You're simply following what the market is already doing. How often do you find yourself checking every little tick as if the next one might change the truth? A trader who fears the market is always looking for reasons to get out. He reads news, listens to opinions, and second, guesses his own work. A trader who understands the market looks at price and volume, and nothing else matters. If the stock is making higher highs and higher lows, that's not an opinion, that's a fact. And facts don't need defending. They only need to be respected. Isn't it strange how a simple line on a chart can be clearer than 100 headlines? I used to say that the big money is not in the buying or the selling, but in the waiting. That's where fear shows up. Waiting feels like doing nothing, and most people can't stand that. They want action. They want to feel busy. But the market pays you for being right, not for being busy. When you sit in a trade that's working, you are letting time do the heavy lifting. Fear tells you to take the money and run. Discipline tells you to stay put and let the trend pay you. Which voice do you usually listen to? Trading without fear doesn't mean you never lose. Losses are part of this business, just like expenses are part of any store. The difference is that a good trader keeps his losses small and his profits large. Fear flips that around. Fear makes you hold losers and cut winners. It whispers that maybe the loser will come back, and maybe the winner will turn on you. But the chart doesn't care about your maybes. It only cares about what is happening right now. Have you ever watched a losing trade sink while you told yourself stories to stay in? When a stock breaks out of a long base on heavy volume, that's the market voting with real money. That's when I want to be in. I don't need to predict how high it will go. I only need to know that it's going higher now. My job is to get aboard and stay aboard until the market tells me the move is over. Fear wants me to jump off at the first sign of turbulence. Experience tells me turbulence is part of every big move. Do you get shaken out just before the real run begins? Your mindset with money is written all over your trading. If you're afraid to lose $1, you'll never make 10. You must think in terms of percentages and probabilities, not in terms of rent money or groceries. The moment you risk money you cannot afford to lose, fear owns you. And a trader owned by fear is no trader at all. He is a gambler pretending to be careful. Are you trading with capital that lets you think clearly? Or are you trading with money that keeps you up at night? I never tried to be right about the market. I tried to be in harmony with it. There's a big difference. Being right feeds your ego. Being in harmony feeds your account. The market doesn't reward stubbornness. It rewards flexibility. When a trade goes against me, I don't argue. I get out. That's not fear. That's good business. Fear is staying in because you can't admit you were wrong. Isn't it funny how pride can cost more than any commission? Charts are just pictures of human behavior. Every bar shows you where buyers and sellers fought it out. When you learn to read those battles, you stop being surprised. A breakout is a victory for buyers. A breakdown is a victory for sellers. Your job is to side with the winner, not to root for the underdog. Fear makes people bet against strength and hope for weakness. Strength is what pays. Weakness is what drains you. Why do so many traders insist on trying to catch falling knives? Building wealth through trading is not about a single home run. It's about a steady series of good decisions. Each trade is just one brick in a long wall. Fear makes you focus on the brick in your hand instead of the wall you're building. When you think long-term, short-term noise loses its power over you. A pullback in an uptrend becomes an opportunity, not a threat. Can you see the bigger picture when the screen turns red for a day? I've always trusted price more than predictions. Predictions are cheap. Price is expensive because it reflects where real money is going. When a stock keeps climbing despite bad news, that tells you something. When it falls on good news, that tells you something too. Fear listens to the news. Wisdom listens to the market. Which one do you let guide your trades? To trade without fear, you must know your rules and follow them like a machine. Where will you buy? Where will you sell if you're wrong? Where will you take profits if you're right? If you answer those questions before you enter, there is nothing left to fear. The market can do whatever it wants, and you already know what you'll do in response. Isn't it easier to stay calm when you already have a plan? Every great trend starts quietly. It doesn't ring a bell. It just begins to move, and those who are paying attention get in early. Those who are afraid wait for confirmation, and by the time they feel safe, most of the move is already gone. Safety in trading is an illusion. The only real safety is being aligned with the trend. Are you waiting for comfort, or are you waiting for opportunity? Fear shrinks winners and grows losers, and you can see it on almost every trading screen in the world, if you know what you're looking at. A trader gets into a position that starts moving in his favor, maybe just a little at first, and suddenly his heart begins to race. He's up a few points, maybe a few dollars, and now he's afraid the market will take it back. So what does he do? He sells. Not because the chart told him to sell, not because the trend broke, but because the idea of giving back a small profit feels painful. That fear quietly closes the door on what could have been a much larger move. At the same time, when a trade goes against him, he doesn't feel the same urgency. Now fear shows up in a different costume. He's afraid of being wrong. He's afraid of locking in a loss. So he holds on, hoping, waiting, telling himself stories about how the market will come back. And that's how fear makes small losses grow into big ones. You can watch this happen in real time on any chart. A stock breaks out of a base, pushes higher, pulls back a little, and the weak hands sell. That pullback was just noise inside a healthy trend, but fear makes it look like danger. The trader who sold early feels relief for a moment, until the price starts climbing again without him. Meanwhile, another stock is falling, making lower lows, and the trader who owns it refuses to let go. Every bounce looks like salvation. Every new low feels like betrayal. Fear keeps him glued to a losing position while his capital slowly bleeds away. It's a strange thing, but the human mind is wired to protect small gains and ignore growing risks, and the market exploits that wiring every day. When you trade, you are really trading your own reactions as much as you are trading price. The chart might show a clean uptrend with rising moving averages and strong volume, but fear will zoom in on the last red candle and make it look like the end of the world. On the other side, a clear downtrend with falling support levels will still look tempting if you are already stuck in it, because fear will highlight every tiny green bar as a sign of hope. This distortion is what causes traders to do the exact opposite of what would make them money. They sell strength and buy weakness, not because it makes sense, but because it feels emotionally safer in the moment. Think about how a trailing stop works. It's designed to let a winner run while protecting you from a major reversal. But fear hates trailing stops. Fear wants certainty. Fear wants to lock in what's there right now. So instead of letting the stop do its job, the trader takes the profit early, often right before the biggest part of the move. That same trader will widen a stop on a losing trade because fear can't stand the idea of being wrong. The result is predictable. The winners are cut short and the losers are given room to grow. Over time, this imbalance drains the account no matter how good the strategy looked on paper. You can see this pattern in every market cycle. During strong bull runs, the biggest gains are made by those who sit tight and let their positions grow. But most people jump off early. They feel smart for a while until they watch the asset double or triple without them. During bear markets, the worst losses happen to those who refuse to accept that the trend has changed. They hold on, convinced that a rebound is just around the corner while the price keeps sliding. Fear whispers that selling now would make the loss real, so they stay in, even as the numbers get uglier. The irony is that fear is trying to protect you, but it does so in the worst possible way. It protects you from the emotional discomfort of seeing a profit disappear, so you take it too soon. It protects you from the emotional discomfort of admitting a mistake, so you let a loss grow. The market doesn't care about your comfort. It only cares about supply and demand. When you let fear make your decisions, you are trading your feelings instead of the facts on the chart. A confident trader understands that a winning trade is supposed to feel uncomfortable sometimes. Price doesn't move in straight lines. It surges, it pulls back, it pauses, it shakes people out. Those pullbacks are not warnings, they are part of the structure of a trend. If you sell every time you feel a little uneasy, you will never capture the moves that build real wealth over time. On the other hand, a losing trade should feel uncomfortable in a different way. The market is telling you that you are wrong, and the sooner you listen, the less it will cost you. Letting a loss grow because you're afraid to accept it is like letting a small fire turn into a blaze. Look at any trader who has been in the game for a long time, and you will find that their success is not built on being right all the time. It's built on having a few big winners that more than pay for many small losses. That only happens when fear is kept in check. You have to be willing to hold on to what's working and let go of what isn't. That sounds simple, but emotionally it's one of the hardest things to do because it goes against our natural instincts. Trends pay, hesitation costs, and that simple truth sits at the heart of every chart you will ever look at. The market does not move randomly the way most people think it does. It moves in waves, in pushes and pullbacks that build into trends, and those trends are where the real money is made. When a stock, an index, or a currency pair starts making higher highs and higher lows, it is telling you something very clear. Money is flowing into it. Buyers are willing to pay more and more. That is not an opinion, it is visible in the price. But hesitation makes that clear message feel blurry. A trader sees the move starting, but instead of acting, he waits. He wants confirmation. He wants safety. And by the time he feels comfortable, the price has already traveled a long way without him. You can see hesitation on every breakout. A market pushes through resistance, volume expands, and the trend begins to assert itself. That is the moment when opportunity is greatest, but it is also the moment when doubt is loudest. What if it's a false breakout? What if it turns right back down? Those questions keep traders on the sidelines while the trend gains strength. Then, after several strong bars, when the move is obvious to everyone, the same traders finally jump in. They feel safer now, but ironically they are taking more risk, because they are buying farther from support and closer to a potential pullback. Hesitation has quietly shifted the odds against them. When you study long-term charts, you notice that most of the big gains come from a handful of sustained trends. A stock that doubles or triples does not do it in one straight line, but it does do it in one dominant direction. Those who get in early and stay with the trend do well. Those who wait for the perfect entry often end up chasing, getting shaken out, or missing the move entirely. The market does not reward perfection. It rewards participation in the right direction. Hesitation keeps you watching while others are riding. There is also another cost to hesitation that most traders don't think about. It eats away at confidence. Every time you see a setup, think about taking it, and then back out, you are teaching yourself to doubt your own work. The next time a good opportunity shows up, that doubt is stronger. Soon you are no longer trading a strategy, you are trading your uncertainty. Trends, on the other hand, build confidence. When you enter in the direction of a clear trend and the market starts moving your way, it reinforces the idea that following price is the right thing to do. Trends don't need to be predicted. They only need to be recognized. A rising moving average, a series of higher lows, strong closes near the highs of the day. These are all ways the market shows you that demand is in control. But hesitation tells you to ignore those signs and wait for something that feels safer. The problem is that safety in trading is usually an illusion. By the time everything looks safe, the best part of the move is often behind you. The trend was the opportunity, and hesitation let it slip. You can think of trends like rivers. When you step into a flowing river and go with the current, it carries you forward. When you try to stand on the bank and analyze the water, it keeps flowing without you. Hesitation is standing on the bank, watching the river go by. The market does not pause to make you comfortable. It moves when it moves, and those who are willing to step in at the right time are the ones who benefit. Another way hesitation costs is through missed compounding. In trading, gains build on gains. A good trade increases your capital, which gives you more power in the next trade. When you hesitate and miss a trend, you miss not only the profit from that move, but also the opportunity to grow your trading base. Over time, those missed opportunities add up. Two traders with the same strategy can end up in very different places simply because one acted when the trend was there and the other waited too long. Hesitation also shows up when it's time to add to a winning position. Many traders get into a trend with a small size, then freeze. The position is making money, the trend is intact, but they are afraid to commit more. They tell themselves they should wait for a pullback or for more confirmation. Meanwhile, the trend keeps moving. Adding to strength is one of the most powerful ways to build large profits, but hesitation turns that strength into something to be feared. The trader stays small while the opportunity is big. Charts reflect crowd psychology in motion, and that's not just a poetic way of talking about price. Every line, every bar, every candle on a chart is the result of thousands of people making decisions at the same time. Some are buying because they feel hopeful. Some are selling because they feel afraid. Others are acting because of greed, relief, or panic. All of that emotion gets translated into numbers, and those numbers draw the picture you see on your screen. When you learn to read that picture, you are really learning to read the mood of the crowd as it shifts from confidence to doubt and back again. When a market is climbing steadily, making higher highs and higher lows, what you are seeing is a crowd that is becoming more and more optimistic. Buyers are willing to pay higher prices, not because the assets suddenly became more valuable in a fundamental sense, but because they believe other people will pay even more. That belief feeds on itself. A rising chart creates more confidence, and that confidence creates more buying. It's a feedback loop, and you can see it in the slope of the trend and the way pullbacks stay shallow. The crowd is not scared yet, so price keeps drifting upward. Then something changes. Maybe the price reaches a level where a lot of people who bought earlier decide to take profits. Maybe some bad news hits the wires. Maybe the move has just gone far enough that buyers start to hesitate. On the chart, this shift shows up as longer wicks, heavier volume on down days, or a failure to make a new high. What you are really seeing is the crowd beginning to argue with itself. Some still believe in higher prices, but others are no longer so sure. That tension is what creates sideways ranges and choppy trading. If the selling pressure grows stronger, the balance tips. A support level breaks. Stops get triggered. Fear starts to spread. On the chart, price accelerates downward, and volume increases. That is not just numbers moving around, it is human emotion moving in waves. The same people who felt confident at the top now feel trapped. They sell not because they have a new plan, but because they want the pain to stop. Charts don't show tears or sweat, but they show the result of both. Understanding this changes how you look at patterns. A head and shoulders formation, for example, is not just a shape. It's a story. It shows a market that tried to go higher, failed, tried again, failed again, and then finally gave up. Each peak represents a wave of hope. Each drop represents a wave of disappointment. When the neckline breaks, it's the moment when the crowd collectively admits defeat. If you only see lines and not the people behind them, you miss the real meaning of the pattern. The same is true for breakouts. When price pushes through resistance, it's not just breaking a line. It's overcoming a level where sellers were once strong. Those sellers have either been absorbed by buyers or have decided to step aside. The breakout is the crowd shifting from doubt to belief. That's why strong breakouts often come with heavy volume. A lot of people are changing their minds at the same time, and that creates energy in the price. Charts also reveal how memory works in markets. A level that was once support can become resistance later, and vice versa. That's because people remember. Traders who bought at a certain price and then saw it fall will be eager to sell if it ever gets back there. They just want to get out even. On the chart, that collective desire to break even shows up as resistance. It's not magic, it's psychology. Even something as simple as a moving average is a psychological tool. It represents the average price that the crowd has paid over a certain period of time. When price is above that average, most people are in profit, and they feel comfortable holding. When price is below it, many people are in loss, and they feel pressure to sell. That pressure influences how price behaves around the moving average, turning it into a kind of emotional boundary on the chart. When you look at volume, you are looking at how intense those emotions are. High volume means strong feelings, either fear or greed. Low volume means apathy or uncertainty. A breakout on low volume is a weak expression of confidence. A sell-off on high volume is a loud expression of fear. The chart gives you a way to measure those feelings without ever talking to a single trader. Risk control is the foundation of confidence, and without it a trader is just guessing with money. You can have the best chart pattern in the world, the cleanest breakout, the strongest trend, but if you don't know how much you are willing to lose on that trade, fear will always sit right beside you. The moment price starts to move against you, your mind begins to race, because you never defined the boundary. You don't know where the trade is wrong, so you don't know what to do. That uncertainty is what turns a small move into a big emotional problem. When you decide your risk before you enter, something changes. You stop worrying about every tick. You already know what it means if price goes to a certain level. It means you were wrong, and you get out. There is no drama in that. It's just a business decision. This simple act of setting a stop loss gives you a kind of quiet confidence that no indicator can provide. You are no longer at the mercy of the market's every twitch, because you have already drawn a line between what you will accept and what you will not. Most traders think confidence comes from winning. In reality, it comes from knowing you can survive losing. If one trade can wipe you out, you will never feel calm. No matter how good your strategy is, you will be watching the screen with a knot in your stomach, hoping instead of trading. But when you keep your risk small relative to your account, a loss is just a scratch, not a wound. You can take it, learn from it, and move on to the next opportunity without hesitation. This is where position sizing becomes so important. Two traders can take the exact same trade, but have completely different experiences based on how much they risk. One might risk 1% of his account, the other 10%. When the trade goes against them, the first feels disappointed, the second feels panicked. The chart did the same thing for both, but their emotional worlds are completely different. Risk control is what determines whether you can think clearly when things don't go your way. Confidence built on risk control is quiet. It doesn't boast. It doesn't need to be right all the time. It simply knows that over a series of trades, the math will work out if the rules are followed. You don't need to predict the future when you have a system that limits your downside and allows your upside to grow. That's the kind of confidence that lets you take the next trade even after a loss, because you trust the process more than the outcome of any single bet. Without risk control, every trade feels like a life or death decision. You might find yourself staring at the chart, afraid to click the button because the consequences feel too big. Or you might jump in recklessly, hoping to make back a previous loss in one shot. Both of these behaviors come from the same place: too much risk. When you bring that risk down to a level you can live with, your behavior becomes more steady, more rational, and more professional. The market rewards consistency, not bravery. A trader who risks too much is not brave, he is vulnerable. He might have a few big wins, but sooner or later a normal losing streak will hit, and his account will take damage it cannot easily recover from. On the other hand, a trader who respects risk can survive those same losing streaks with only a small dent. That survival is what allows him to be around when the next big trend appears. You can see this in the way experienced traders talk about losses. They don't get emotional about them, because each loss was already accounted for in their plan. It was the cost of doing business. They know that no setup works every time, and they are okay with that. Their confidence comes from the knowledge that one loss does not define them, and one win does not either. It's the long run that matters, and risk control is what protects you in that long run. Risk control also changes how you handle winners. When you know your downside is limited, you are more willing to let a good trade run. You don't feel the same urge to grab a small profit and run, because you are not afraid of losing everything if the trade turns. You can give the market room to breathe, to fluctuate, to do what it naturally does in a trend. That patience often turns a decent trade into a great one. Many traders focus all their energy on finding the perfect entry, as if that is where success lies. But entries are only part of the picture. What really matters is how much you lose when you are wrong and how much you make when you are right. Risk control shapes both of those numbers. It keeps the losses small and allows the wins to grow. Over time, that difference adds up, even if you are right only half the time. When you look at a chart with a clear plan for risk, it stops being intimidating. A volatile market is no longer something to fear, because you know exactly how much it can hurt you. A slow market is no longer boring, because you know you are not forced to trade. You are in control of your exposure, not the other way around. That sense of control is the bedrock of confidence. The market is unpredictable, but your response to it does not have to be. You can decide in advance how much you will risk, where you will exit, and how you will size your position. Those decisions create a framework that keeps your emotions in check. Inside that framework, you are free to trade what you see on the chart without being overwhelmed by what might happen.